All right, Drew, let's go ahead and get started here today. Welcome everybody. My name is Zach DeSetti. I'm one of the advisors here at InfiniTALKS. With me presenting today is Drew Heffernan, and we're going to be talking about general gifting, and then we're going to get specific about different charitable giving methods. These are things and strategies that our clients are using, every year. We're having a lot of conversations at the end of the year talking about where to give. And as a quick reminder, we're going to talk about a lot of different strategies today. And, please make sure that if you hear something that has piqued your interest, please get with your advisor, especially if you're working with someone here at InfiniTALKS, or if you're not working with someone here at InfiniTALKS, get with myself or Drew. We want to definitely make sure that all of the strategies we're talking about are run through a CPA or an estate planning attorney. When it comes to some of these giving types and techniques, there's different phase out limits and different AGI limits and limitations sometimes as to what you can do. And we're going to cover some of the basics of that today. But just as a quick reminder to go ahead and make sure always consult, with a tax professional as well as your advisory team, for any of the strategies you hear today. To get us started, of course, what's the purpose of giving? We all find, our own purpose. A lot of times it's to transfer wealth to, our family, other individuals, charities, and organizations that are near and dear to us. A lot of times maybe religious or faith-based organizations or specific causes. Are the places that we find ourselves giving to. And not that necessarily the tax component, is not driving all of that decision, but where we can, we will definitely take advantage of some opportunities to reduce tax, to reduce the size of your estate, which we'll cover later about, the estate tax, if you have concerns about that. Again, all of these ways are different ways to give, and everyone has a different reason to give. And we'll cover some of those things today, some things that Drew and I are seeing, when we're working with clients. We can start out on the far left-hand side from the least complex way to give, whether it's cash or when it says personal property, it really means, different types of assets. We get a lot of questions from clients on if they should gift their home, to their kids, or if they should pass it, through a trust or will at the end of their lifetimes. What do we do with life insurance, real estate? We'll talk about qualified charitable distributions or deductions, QCDs as they're known. And as you move right on our chart here, it gets a little bit more complex, but giving to different structures, philanthropic structures, donor advised funds, community foundations, those are common strategies that a lot of people are doing. And that kind of is where the tax component, comes into play. Can we take advantage of maybe an itemized deductions versus just taking the standard deduction? Drew's going to talk about in a little bit how donor advised funds are really good strategies for that. We won't touch a whole lot on the different types of trust that you can use, whether charitable remainder trust or charitable lead trust, known as CRATs or CRUTs or CLATs or CLUTs, if you know the acronyms there. Pooled income funds. Again, if you are interested in that, please, again, get with Drew or I afterwards, and we'll gladly talk about that more. And then kind of on the far right-hand side, the most complex way to give is through different private foundations. There's a whole different set of rules as far as deductions and limits and what you can do there. So we're going to focus a lot today on kind of the far left-hand side, some of the things that I think are very common that people are using every year. We'll get into some of the more complex donor advised funds, QCDs as well. As a quick reminder, some of just the basic gifting rules. This year, you can give $19,000 as an individual, or if you're married, $38,000 as a couple, and that's you can give that each year, and that's per beneficiary, per individual giving that. So maybe you have one child or one grandchild, that all of that goes to that one person. The lifetime exemption as well was increased with the One Big Beautiful Bill Act to $15 million per individual, or $30 million as a married couple. So again, if you're facing maybe an estate, tax. That is kind of the limit to where some of your estate would start to be taxed federally. Their states have their own different exemption limits. Again, that's where some of those more complex strategies as far as the lifetime income trust or remainder trust, definitely come into play. Drew's going to talk a little bit more about QCDs, but for this year, 2026, the limit per QCD is of $111,000 per individual. So again, as a married filing jointly, you could each do a QCD from your respective IRAs. One other limit to be aware of, and this is not on the slide, it should be, but the One Big Beautiful Bill Act recently passed a new deduction for cash gifts. And that's if you're not itemizing. And so each year you're going to be able to take credit for a $2,000 deduction above your standard deduction. Again, if you're not itemizing, you do need to keep receipts of those cash gifts, but you will start to get credit for $2,000 of cash gifts. A lot of the strategies that Drew's going to talk about here are for itemizing taxpayers. So again, that's part of the strategy that we're helping clients get to, which is what is the income as far as different itemized things like medical expenses, your state and local taxes, your mortgage interest, and charitable giving. If we can increase those deductions to be greater than the standard deduction, that's where we can really make a big difference from a tax standpoint. But just some key gifting limits there for you for 2026. And I believe at this point, I'm going to hand it over to Drew, and he's going to drill down specifically on some of the donor advised funds, QCDs, and the actual strategies that we're using with clients.
Thanks, Zach. A couple things that we're going to start out going over here is, like Zach mentioned, the donor advised funds and QCDs specifically. So we're going to start kind of with the donor advised funds here. There's three big buckets that we could use when donating to this donor advised fund. So what's a donor advised fund? Let's just high level here. What it really is a charitable investment account. And so just kind of keep that in mind as we kind of go through the basics of it. And then the next slide will kind of dive a little bit more into some of the complexities of what a donor advised fund really is and how it works. So these three main buckets that we're going to be putting into the donor advised funds, there's wills and bequests, which kind of would be like a taxable asset. So something that's already been taxed. So something like maybe cash or stocks, as Zach mentioned earlier, personal property. So that could be a good example that I've always heard is like a coin collection, maybe a gun collection if you have something like that, but something that you are wanting to specifically gift into that donor advised fund. And the second one would kind of be the tax deferred plans bucket. So these are going to be like your IRAs, 401ks, qualified types of plans. And then finally, life insurance proceeds. So once someone actually has to use those life insurance proceeds, it's a big bucket of cash. And being able to utilize a donor advised fund to kind of help with time and flexibility on those funds, it's a really good way to kind of help out whoever's trying to deal with all those life insurance proceeds. So like I mentioned earlier, now we kind of get into the donor advised fund. It is, in essence, a charitable investment account. What it does is all these funds get into this donor advised fund. They can be invested, and they really give the flexibility and impact of exactly when and how much you're wanting to put in initially and also send out as your charitable gift. So some of those things that like when we're sending out charitable gifts, one of the things is we kind of look at the slide and get down below that donor advised fund block. And you can assign successor advisors or successors in general who their instructions are to divvy these assets that we've already put into that donor advised fund, how you want it to go. So that could be towards charities. Depending on the charity, these successor advisors and successors are going to be taking instructions from you on how you want it exactly allocated. Another one would be, at your passing, you want to send it directly to a charity. So this is kind of, instead of going through the successors or the advisors, you're kind of list in the donor advised fund exactly who you want to give it to. And then finally, the charitable legacy. So one thing with the donor advised funds we kind of mentioned is it's a flexible investment account. So that, at the donor advised fund owner's passing, it doesn't mean that all these assets have to be distributed immediately. There can be a clause that says we want to give it to a certain charity over time rather than all at once. So we'll go to the next slide there, Zach. So kind of getting more into the specifics of the donor advised fund. Really, like I had mentioned earlier, it's going to help simplify giving while also maximizing your impact to the charity that you're wanting to give to. But so as you can see on the left side of the screen, we've got putting in cash or appreciated assets. One strategy that is highly utilized on a donor advised fund would be donating highly appreciated assets. So these are assets that you've had that have grown to a very large scale. They have a low cost basis. And if you were to get rid of this asset or liquidate it, it's going to cause you a big tax burden because of all those gains. Well, if you were charitably inclined, a good strategy is being able to take those assets, put it in that DAF, and let it continue to grow over time. And whenever you're ready, you can go ahead and liquidate it or however to donate it into the charity when you make a grant, is what it's called. So when you actually take the funds from that donor advised fund and grant them out to the specific charities, it's called a grant. As you can see down on the bottom right hand of the screen, we need at least $50 per grant. And then on the bottom left, excuse me, the donor advised fund has to be opened with an account minimum of $5,000. So as I mentioned, when the cash or appreciated assets get into that donor advised fund, the charitable investment part of it is able to take those funds, invest them, whether it's highly appreciated stock already or just investing it in the market. So it gives you that flexibility that, in tax year of 2026, we would love to put a lot of our hard-earned assets into this donor advised fund so we can take advantage of that deduction as needed in the year of 2026. So maybe we don't want to grant it all this year, but we want to have the ability to use that tax impact in this individual year. So that's where that donor advised fund comes into play, is you're taking a huge itemized deduction in year of 2026, for example, putting in that donor advised fund, letting it grow over time, and using that investment management of your advisor CPA to be able to help you get those assets to grow. And then once you're ready, you can grant over time. So as I'd mentioned, the minimum grant is $50. And as long as it meets that $50 threshold, you can donate in year 2026, 2027, 2028, all with those same funds that you put in 2026. So one of those big advantages of the donor advised fund is just the flexibility and impact. You're able to take all the funds that you wanted to use for that deduction, let them grow over time, and maybe a couple of years down the road, it's a better time to give to the specific charity that you have in mind. So you really get the flexibility with that impact that you're able to give them in 1 year rather than just pulling from a normal investment account over time. Go to the next one, Zach. So then we kind of briefly touched on the tax deductions. I wanted to drill down a little bit more here. And what we're going to do is compare the donor advised fund to private foundations. So each time you make a gift to charity, depending on the type of asset that you give, it has a different percentage of deductibility that you get according to the IRS. So if you look down here on the left side of the screen, one good example would be cash. So if you're going to take cash and put it in your donor advised fund, you have the potential of getting up to 60% of that value of the cash deducted on that tax return for the given year that you contribute, as opposed to a private foundation, which is only about 30%. So it really incentivizes, if you are going to use cash, to throw it in that donor advised fund. Like we had mentioned earlier, it's all about the flexibility and impact. So you can take that cash, have your advisor or self-advised invest it however you want to let it continue growing, and then use that as you feel appropriate in the year that you want to contribute. As you keep going over, you can see that publicly traded securities held longer than a year is at 30% for donor advised funds and only 20% for private foundations. And then the next one over talks about real property, so real estate and privately held assets, which could be ownership interests in companies and things of that nature. But what we're able to see here is just the tax deduction impact that you can have putting money into a donor advised fund, and also the different types of deductibility rules that those specific assets have when you're putting them into that donor advised fund or private foundation. Now, one thing to make sure you do is consult your CPA on any of these strategies when you're going to try to implement them. It's going to be different for every person in every situation. So that's one thing that we want to stress, is make sure that you do consult your CPA before trying to take advantage of any of these strategies that we're listing out today. The next strategy that I really wanted to get into is the qualified charitable distributions, or QCDs, as you've heard them. So a QCD is a direct transfer from an IRA or a 401k to a qualified charity. So one of the things with a 401k or an IRA is, once you reach age 73, you're required to take out a required minimum distribution. If you don't know what that is, it's a way for those funds that went into that account before tax to end up being taxed when the money comes out. So one of the strategies is this QCD allows you to actually take funds from an IRA or 401k and directly donate them to a charity. And why I bring up the required minimum distribution is, a really good strategy would be to use the QCD to mitigate your required minimum distribution. The required minimum distribution is going to basically count as taxable income in the year you're required to take it, and that qualified charitable distribution does not count as total income when you donate it. So you're able to lower your taxable income, help satisfy your required minimum distribution, and it could also help with your tax thresholds, such as IRMA, which would be Medicare thresholds, and also Social Security. And one thing I missed is some of the key requirements on those QCDs is you're not allowed to utilize the QCD until you're age 70 and a half or older, obviously. The QCD must go to a qualified charity, and the annual limit is $111,000. So as I mentioned, it really helps when you're of the age where you start taking required minimum distributions. And one of the other times that a QCD would be applicable is when you are charitably inclined. But as Zach had mentioned earlier, you're not itemizing your deductions. So if you're just taking the standard deduction using these QCDs, it will help lower your taxable income. So we're not worried about the itemizing deductions, and it helps you lower your adjusted gross income just to take advantage of some of these other things, like I've mentioned, with the different tax thresholds and whatnot. We just kind of wanted to go over some just general gifting strategies that as we already mentioned, the annual exclusion per year is going to be $19,000 per person. That does not include married couples. So if you are a married couple and you're wanting to use an annual exclusion, that amount, since it's only $19,000 per person, would actually be $38,000 for the married couple. So this is good to if you're charitably inclined, looking to help out family. As Zach mentioned earlier, everybody has a reason, but being able to utilize the 19,000 or 38,000 for married couples is allowing you to gift annually without going towards the lifetime exemption, which I'll go into next. The lifetime exemption limits are 15 million in 2026, which basically means over your entire lifetime, anytime that you go over that annual exclusion that we just talked about, there's a running total that goes towards that 15 million per year. So if you do end up going over the 19,000, what it does is it counts towards your 15 million that you have as a lifetime freebie until you start getting taxed at the federal level on those gifts. So one strategy on that lifetime exemption is actually gifting those appreciating assets earlier, and it helps reduce your overall estate value. Once that estate value gets to a certain point, which I do believe is 15 million in 2026, there's a hefty tax burden that comes with that estate plan being over that 15 million amount. So utilizing these annual exclusions and the lifetime exemption, we're able to get that estate value down below the annual limits, lifetime limits, which are going to incur those hefty tax burdens. So these are some of the strategies that if you talk to your advisor or CPA, they can help you out with, and make sure that you're utilizing them to the fullest. One other strategy we wanted to talk on today was the upstream estate planning. So this would be a strategy where this would be someone younger gifting to a parent or a grandparent in the hopes that, you know, they have a highly appreciating asset. They're going to hand it off to their parent or grandparent. And while their grandparents or parents have it, that asset is appreciating. And then at their passing, that asset would come back to those individuals. So things such as stocks, this could be real estate as well, but gifting it upstream allows that, child or generation to get those specific assets out of their estate plan, move it into a generation above them, and then once that generation above them were to pass away, the big benefit is the potential step up in basis at that recipient's passing. So just another little tidbit to think about when looking at your estate planning and how to make sure that you're staying under the limits to make sure that we are effectively not paying those higher taxes on our estates. So just kind of to reiterate, we've got the annual exclusion, which is about 19,000 per person, the lifetime exemption, which is 15 million per person, and then we've also got that upstream estate planning, which talk to your financial advisor, and they can also help you implement that into your financial plan. And with that, I'm going to turn it over to Zach to talk a little bit about the InfiniTALKS Cares.
Great. Thanks, Drew, for going over some of those strategies. And again, for those of you who haven't heard of any of those strategies, or maybe you've started to talk with your advisor, I know Drew and I both use the Right Capital planning software along with a lot of other advisors. We have the ability to model some of those distributions and deductions and help your CPA, not that they don't understand, but help them start to model it out. And you have kind of a couple teams looking at all at it together. So that's great. I am one of many members here at InfiniTALKS that sits on the InfiniTALKS Cares Committee. Since we started this foundation in 2020, we've given over $350,000 to various organizations in the Kansas City area. What we try and do is give a quarterly grant each quarter to a local organization that's a little bit maybe on the smaller side, to where our dollars have a very large impact. If any of you current clients were at our movie event, in the top left picture there is the Odin George Foundation. If you came to our movie event, you remember seeing the trailer with them speaking. And that was just an example of a great organization that we've supported that's here local in Kansas City. This year in 2026, we were able to increase our quarterly grants again for the fifth year in a row to $8,000 each quarter. The committee has recently just voted and announced that Avenue of Life here in Kansas City was the recipient, of the first quarter grant. So we're super glad to be involved with Avenue of Life. Some of the other quarters coming up are going to be veterans. We have animal welfare and rescue, and then fourth quarter we'll have children and kind of to their families and the support there. You'll see on your screen a QR code. What that QR code goes to is the InfiniTALKS Cares grant request form. When I'm meeting with all of my clients, I'm always asking them, what they're doing from a charitable standpoint, what they're doing from a volunteer standpoint. So that way, if there's ever an opportunity for us to partner, with them, maybe it's through one of these quarterly grants, maybe it's through one of our quarterly volunteer days that we do, as an office, we want to know what you as our clients are doing, out in the community, and maybe we can pair those things up and make a greater impact. So use the QR code on the screen. That comes to a couple of us on the committee each quarter. Towards the end of the quarter, we take all of the recipients, that we receive. For example, in the quarter two, we'll take all the veteran foundation and organizations that have been submitted, and we vote on who's going to receive that $8,000 grant. But we'd love to hear, who you are working with, what organizations are near and dear to you. With that, we will wrap up for today. And Lauren, I believe we can open the floor. Are people allowed, I think, to unmute themselves and ask any questions to Drew or I about maybe some of the strategies that we covered today, or InfiniTALKS Cares and what we're doing in the community? We'd be happy to stick around here for a little while and answer any of those questions. As a quick reminder, today's session will be recorded. So maybe if you joined in a little bit late and missed, some of our first couple slides, or if you know someone who was planning on attending and they weren't able to, this will be posted to the InfiniTALKS website probably in the next week or two after we run it through compliance. And so you'll be able to find it there if you want to come back.
Can you hear me?
Yes, we can hear you.
All right. I was just wondering if you exceed in a given year, if you exceed the 30% or 60% AGI limitation, does that carry over? Can it be utilized in future years?
Yeah, there is a 5-year carryover, on those, so it can be utilized in the future. Yes.
Because that was a big change with the big beautiful bill, right? That they reduced stepped up gifts to 30%, where it used to be the larger amount, I believe.
Yeah, and it's a percentage, of your AGI. So yeah, they just limited the amount that you could do in that initial onset, but they did keep that carryover. Yes. So thank you for that. Yeah.
Yeah, I have just a question or comment. We're required to give QCDs, RMDs, which we do, and it's well below the 111,000. But after we go over the RMD threshold, we were talking to our tax advisor, and he said, because we'd like to give some additional monies to charities, that he recommends, from a tax benefit perspective, using our qualified funds to do the QCDs rather additional monies out of QCDs rather than a donor advised fund, that there are more advantages associated with the QCDs than a DAF. Those were his comments, and I'm just curious if you have any input or thoughts based on what he said. Again, that's our tax accountant.
Yeah, thanks for the question, Steve. If you, and I think Drew chime in here, if you've hit that 70.5, I do agree that the QCD likely is going to be the most tax advantaged way because there is no limit, like we were talking about with donor advised funds, like the 30% or the 60% for cash. With QCDs, the limit is the 111,000. So I think you're spot on there, Steve, that if you've satisfied the RMD, maybe you had to take only $50,000 out in a given year, but you wanted to give maybe a total of 75,000. You can continue to do that, and that just reduces the total qualified account balance, which reduces next year's RMD. So it kind of goes hand in hand to continue a QCD if you're 70 and a half as your primary giving. If you want to maybe do more than the 111,000, that's where then you would maybe pivot over to the donor advised fund after you've satisfied that full amount.
Yeah, I got nothing to add.
Thanks a lot.
It's pretty spot on.
Appreciate it.
Yeah, thanks for the question, Steve. All right. Well, if we don't have any more questions, again, please look for this recording. You see on the screen here, info@infinitalkskc.com, as well as our phone number. Feel free to give us a shout, ask for myself or Drew, or maybe, again, if you're already working with an advisor here at InfiniTALKS, gladly send them some questions. We appreciate you joining for another session of our InfiniTALKS series, and we look forward to seeing you all through the rest of the year.